Welcome friend to my YouTube channel, and today we are discussing option trading for beginners. So now our today topic is option trading for beginners. So now the option trading is very important topic to make you the profit from the stock market. So every one of us are very anxious about what is the option trading. So I try to put up a very simple way. I try to explain the option trading so that you can understand the option trading and you can make a best trading decision in option trading. So these are the points I will cover in this video. So stay on this video until the last. So I request you to please subscribe my channel and please hit the bell icon. So now let's get started. So now the option trading. So we will consider this point. So the first point is option trading. So what is option trading? In option trading, option trading is future predetermined trading. So in option, in normal trading, traditional trading, what happens? We buy the stock for the certain price. If the price goes up, then we can sell those price. If suppose, for example, the today's price is 100, suppose X stock is 100, then if that is 110 in some point of time, then we make the profit of 10 rupees. So similar way, the option trading is totally different from the stock trading. So what is option trading? So option trading is the predetermined. Option trading is enables you to make the contract to trade. It's not obligation for you. It's not obligatory contract. It is not also mandatory, but it makes you the agreement in the contract to buy some security or trade in some security in the future predetermined time within the expiration date. So what this means is that if suppose normal trade, what's happened, we buy some stock. Let's take an example. On the SDI we buy suppose 100 shares for the 100 rupees for time being. In the next course of time, so let's take an example, in the next 20 days, if my stock is increasing by the 20 rupees, so it will become 120. So in this way I can make the profit by making the by selling this stock or the higher prices. So in option trading, what happen? You are predicting the price. So let's take an example. If there is a price of SBI, current trading price is 100 rupees. If you assume that in future, so in 3 months or 2 months, the price will go from 100 to 200. So on the basis of your prediction, you buy the options. So there is an options agreement. So you hold the contracts and you purchase the stock, and when the price will move in the 100. So if your predictions are correct, then you will get the profit after the SBI stock price get increased above the 200. So this is the option trading. So one of the benefit of the option trading is that as I compare with the traditional stock market trading. So in the traditional stock market, so as a regular stock market, so there you can buy the stock and sell the securities. So at the point of time, you are not hold to the expiration period or some time bound. So if you think that if the prices are increased at the point of time, then you can sell and make the profit. But there is also wrong, so your assumptions will not be correct. So market is, no one can predict the market when the price will soar or come down. So there is an unpredictable situation. You do not predict correctly in the stock market. So option trading is the best way so that you can hold some assumptions that the price will move on this certain level. So if that assumption will wrong, if the price will not move to that certain level, then there is an option that you can sell. You doesn't buy. You can remove from the agreement. So you can take back. So that is one of the benefit. If certain point of time, if you are you are trading in option trading. So if there is a horizon that okay, there is no seems that the price is going to soar further, and the price, your prediction is wrong. The price is getting down. So what you predicted, my prediction was the price was getting up, but now the price was getting down. So in that case, what you can do, you can remove from the agreement without any cost. So that is the benefit of the option trading. So there is a terms and terminologies I try to cover in this video. So the option trading has the call option and put option. So what is the call option? The call option is to buy the security. So in the call option, what you can do, if the price, let's take an example, if you want to buy the price at a certain threshold, and if in the call option you are able to buy the securities for the predetermined time, for the set number of times period that it will be what according to your agreement. Let's take an example. In call option you can have the suppose X number of, so X is your company and you are buying the stock for the X for the certain predetermined time. Let's take an example. In either for the 3 months you have hold the contracts for the 3 months with the X company, and you buy that option. You buy that option is a share. So like in normal course, if you buy some stocks from securities, so it is stocks or securities depending upon the options which you are trading. So let's take an example. You are stock. You are doing the option trading in equity. So you buy the equity in the agreement and you enter inside the agreement. So buying option is called as a call option. So similar way the put option. So if you enter the agreement of the option and you predict that the price is going to be down in the course of future. So in future you assume that if there is a sluggish, the market will be sluggish and the price will goes down. So in that case you can choose the put option. The put option is basically the sale. You can sell those securities in the predetermined time in the future. So if the price will go down at that time period in the future, you can have the put option. So that is about the call and put option. So how option works? So there is an option. How the option works is that so first condition. So how the option works? So there are the how the option works. Yeah, so I will cover the how the option works. So there are the many of the, so how the option works. So yeah, so let's take an example. As I explained earlier, that the options is the yeah. So the option, how the option work is that if you buy some securities for certain period and you hold and you wait for the future if the agreement complete. So within the expiration date, if there is an expiration date of the 3 months, let's take or the 2 months. So within that period, if your stock will move, if you have the call option, if that price will go up and at the certain thresholds, if your agreed price, suppose you hold the option for the 200 rupees and the market price is 100 rupees. If the stock moves to the 200, then your option will work and you get your option will be executed. Call option will be executed, and based on that, if the price further rises above the 200, then you get the profit according to your price level. So I will cover that in the example. So I basically try to cover how the option works. So similarly the put option. So how the put option works. So let's take an example. You have purchased the securities now and you are predicting that the price will goes down. So based on that, if the price if the stock is trading at 100 and the strike price for this agreement will be 90 rupees. So you can we can hold into the agreement. You can move into the agreement and wait for the certain period of time. Let's take example, if you are entering the 2 months contract of the option, and if the price is going down to the 90, then your trade will be executed and you will enter into the put option. So after the execution of the put option, if the price will goes down further from the 90, let's take an example, it will goes to the 80, 70. So according to that, you will get the profit. So I try to cover the call option and put option. So now what is the option trading? That so basically the option trading is hold some security now, enter into an agreement, hold the security for predetermined future date and time, and if the price will goes up, then your call option will be executed, and from there, if there is further increment in the price level, then you are getting the profit. Similarly, in the put option, so if you buy the security at the point of time, so now you enter in the contract for the 3 months, and you are assuming that the price will goes down, and if the price will goes down, so according to the these, if the downtrend will happen, as per the downtrend you will get the profit. So in this way the option trading is work. So there are the certain terms that we need to understand in the option trading. So these are the terms in the option trading that we need to understand to start trading in the option. So strike price. So strike price is the price that is decided, that is predetermined future price. If the price that will go in future, it will be up in the call option, it will be down in the put option. So the strike price is a future price that it will be traded. So that is the strike price. Open interest is the price. Open interest is the open contracts, number of contracts that will be open for you to trade. So open interest is like that if there are the certain companies that offer the option trade. So depending upon the price level, if it suits, you can enter in the multiple contracts. So this is the open interest. It means that you can trade in the multiple contracts, multiple options in the option trading. The strike price interval is the price that is going to be the price that you can sell before the contract ends. So let's take an example is you are trading the option contract for the 2 months. So for the 1 month, the price is the price exceeds the strike price. Let's take an example, you buy the shares for the 100 rupees in the option trade. For the 200, now after 10 days, the price soars to the 200 rupees. After the 200, you within the 1 month, if the price touches to 220, then you can have the decision to sold within the contract. So that is the strike price interval. So it is the concept of the strike price interval that you can hold the security within the specified time, or buy the, or sell the security. Then the lot size. Lot size is the total number of options, total number of stocks you are buying. So the lot size is the units, total units of the securities. It may be shares, it may be equity or assets, anything. So lot size is the total units. So basically in option trading, you are liable to buy in the lot sizes. So there are maybe 100 lot size, 200, or depending upon your investment, you will be allotted a lot size. So basically the lot size is number of units. Then the expiration date. So expiration date, as I mentioned, that it is the contract. So it will be it holds for the specific period of time. If the security price will move up in the 3 months, so there is expiration date. So within that expiration date, you need to sell or buy the security. So after the expiration date after the finishing the expiration date, then your securities, what they call or put option, it will automatically executed on the price, and you will be removed from the contract. So that is the expiration date. So now let's take an example. I try to cover the simple example to understand how the option trading is going on and how you can do the option trading. There are the simple examples. So let's take an example of the SBI. So the SBI current market price is 500 rupees, and you purchase the stock, the 15,000. You have purchased the lot size, so that is the lot size. So the SBI current market price is 500. So you have predicted in future. You have done some technical analysis or some market analysis that for the 3 months the market price will be touched to this level. It will go to 600, 700, or 800. So based on this assumption, you put some buy means call option. You buy for the 530. So you put the call option. You have hold the call options, and the premium is 10 rupees. So for the 10 rupees premium, you have buy for 530. So what happened? So let's take an example. The price is 500. So for the 500, if there is a no further increase in the price, so your premium will be liable. So within the 3 months, if your price will not touches to any moment, it will stay to the 500. Then you can get your premium will be deducted. That will be your loss. So on the next, if the price touches to the 520, then also your premium will be deducted. Only the premium will be liable for you, because we have the buy for the 530, and above the at this point of time, if the share stock reaches that price level, then your call option will be executed. So now at the 530, so now the price reaches at the 530. So what will happen? So again your premium will be deducted, because from further 530 you are liable for the profit. So let's take an example for 530 also. Your premium will be liable if the price will doesn't soar or doesn't increase. So in future, so let's take an example. After some point of time, within the 3 months, if the price touches to 540, so there is an increment in the 10 rupees. So here, this is your premium at 540 minus 30. So this is 10. So plus minus 10 plus 10, so 0. So here at this point of time, you have no profit, no loss. Okay. So in this way, if the price touches, if your assumption is correct, the price touches to 600. So what happened? So you will get the 70 as a plus surplus. So 600 minus 540, it's 70. So 70 rupees is your profit, and your premium, deduct your premium, and your net income will be 60 rupees. So in this way, you can earn the profit if the market, the price ups to the 600. So this way I explain you about the call option. So in the same way, I try to explain you the put option with the same example. So in the put option, we can let's keep the current market price as 500 and lot size as the same. So you are predicting that after the 3 months, the SBI will be down. So how much it will be down? So it will down by 400, 300 and 200. So you decided that you have done some analysis, and after the 3 months, the SBI price will be down from current market price to 400, 300 or 200, any range. So you decided to have the call option. Call option means you want to sell. Okay. So you are entering in the put option. This is the put option. So selling is the put option, and the premium rate is 10 rupees. So what will happen at this point? So you have entered into the put option. Now let's take an example. If the market price is 500, so as it is, so current market price is 500. So your premium will be liable for you if there is a no increment in the price. If the price doesn't rise above the 500, if the price doesn't go down below the 500, then your premium 10 rupees will be liable. It will be deducted. So yeah, now the price come down and it becomes a 540. Okay. So 540. So here also your premium will be deducted. Your premium will be deducted, and because of you have not touched the contract price, because your put options will not have been executed. So you are liable for that. Your premium, if the price stays remain at 540. If the price further drops and is goes below 540, so now the price will goes to the 430. So the price will move to the 430, and now your sale price was the 430. Your put option will be executed, but at this point of time, your 10 rupees premium will be deducted. So again you are waiting, and the price start decreasing further. So at this point of time, your premium will be liable. And again, if the price came down and it becomes 420, yeah. So here your premium will be 10 plus your amount have increased by the 10 rupees. So again, there is no profit, no loss. At this point of time, you are not getting any profit or any loss. So further, if your price come to 350, so price further reduce and it come to 350, so you will have the 70 rupees as your profit. So to deduct this 10 rupees from this 70, and now your net income will be 60 rupees. So according to the movement of the market, if the stock moves upward, then you can earn from the put options. If the market is down, you can earn from the call options. So I try to cover all this scenario, how you can make your profit, and option trading is very beneficial as compared to the stock market. So the benefit of the option trading is that you can withdraw your contract, you can remove from the contract if the time period is 3 months. If in this threshold you have the put option and you see that the price will not further goes down for the 430. So based on assumption, you can withdraw from the contract. You can withdraw from the contract, and you can save your losses. So that is the benefit of the option trading. So in this way, I explain the option trading, and with the example, with a very simple example. So I hope this will guide you what is option trading, and it will further guide you to how to invest in the beginning. So I hope it will be helpful for you, and please subscribe my channel, hit the bell icon, and never miss the update. So let's keep watching and keep moving forward.